Hi, my name is Roger Schluter. This video is about the three most important items in getting a business loan. I know I've done a couple, how to write a short business loan proposal, and then I've done all the ingredients to that. But these three are actually in there, cash flow, credit, and collateral. And these three are actually the most important parts of any business plan or of any business proposal to a bank. So you want to make sure you get these right. You want to make sure you cover them and you exceed information on these items because you really want to make sure you get it right. Number one, cash flow. Cash flow is the most important aspect of business lending. Obviously, you need to pay your loan payments in a timely fashion, and the bank really wants you to make them, all the time in a timely fashion, not just once in a while. So, cash flow is the whole way you do that, because you're going to have some non-cash charges that are on your income statement, and it depends how you do it. If you're Schedule C, you may not. But anyway, the cash flow is the net income of your business, either monthly or annually. It's the cash part of your business, and the cash part is either what pays bills, what pays your salary, or what is saved to buy equipment or to buy other things. And like I said, you're gonna add back in non-cash charges like depreciation. Depreciation is usually only when you're charging back an item that is being used, and in the thought of it's being used up. So if you're talking like equipment or maybe cars or trucks, yeah, they're probably getting used up. But when you're talking real estate, if you take care of it, a lot of times it's increasing in value, and you still get to take that depreciation. I think they make you take it on a pretty long term, like 30 years or something. With the cash flow, you also have measures of cash flow, and the banks usually use the main measure of cash flow, main measure of ability for you to pay your debts on time, and it's called the debt service coverage ratio. It's basically used to show a lender to what extent your cash flow can cover your debt service, and that's either monthly or annually. But if you're doing projections that are annual, then it's going to be annual, and it is your total cash flow, and you divide it by your total debt service for a month or for a year. And then so that's the formula: total cash flow divided by total debt service. The number needs to be greater than 1, because if you're 1, then you're basically covering your cash flow with your debt, and you've got no money left over. So it gets a little too tight. Lenders are going to think, well, even maybe you've already got, an expense for salary in there, so you're not going to go broke, but you don't have any room for error if you're at a 1-to-1. If that cash flow dips a little bit, you won't be able to pay your debt. So anyway, the number needs to be greater than 1. Most banks want it, if it's a typical company, they want it at about a 1.2 to a 1.3. And of course, the higher is the better. I mean, and I know I've said this in other videos, I've heard of people, but 3-to-1 or 4-to-1. But the higher is the better. So anyway, the number needs to be greater than 1. Banks like a 1.2 to a 1.3 coverage ratio. SBA is a lower bar, and they'll actually accept a 1.1 cash flow or debt service coverage ratio. The higher the better. You could have a 3 or a 4, which would be extremely high. But anyway, banks want you to pay your debt and have money left over, and that's kind of what you want too. You want to pay your debts and have money left over, so you can either put it in your pocket, or you can buy things, or you can buy assets for the corporation or the company. Credit. Credit's the number 2 most important thing. The banks want your credit score. They want it. That's basically what they look at, is your credit score. They're not really, sometimes they may look at the rest of it, but they're basically looking at the score, and that's pretty much at the beginning of the credit report. Scores are compiled by credit bureaus, and there's basically 3 credit bureaus. There's Equifax, there's Aspirin, and then there's TransUnion. Now, TransUnion is really the one we use here in the Midwest. But all three of them, and you can get reports on all three. Now, you will probably get a different score. It really depends on the credit model they use. Credit bureaus compile your credit. They compile it by taking, if you have a Walmart credit card, if you have a JCPenney credit card. It used to be Sears, but they're not too relevant anymore. But anyway, if you have any of these credit cards, they're going to go ahead and they're going to keep track. Those companies are going to send that information in when you've paid on time, when you've been late. But to a credit bureau, it's a 30-day late. So if you're making like a 5-10 day late, or it's 2 days late, it's not going to hurt your credit. Your credit is basically based on the 30-day period. So if it's 30 days late, that's a pretty bad mark. But it is the only mark that the credit bureau is going to make. They're not going to put down that you were 2 days late for a payment. So anyway, most of the credit bureaus, they'll give you a score, and like I said, it's based on that credit model that's used. Most scores are between 300 and 850. 300 to 630 is considered poor. Sometimes, with SBA, we can sometimes do loans when the individual's credit score is like low sixes, and really that's when they've had kind of an event, and then they're turning things around. So when they look at the credit score, they can tell they've made all their payments on time for like the last year or two. Fair credit would be 630 to 670, and there was a time when good credit was all the way down to 630, but since in the last few years they've moved that up a little bit. So anyway, good credit would be 670 to 700, and most banks feel if you get a 700 credit score or better, you're good. They're not really going to look at it. They're just going to look at that score and say, hey, he's good. And really now it's 670 to 700, you're good. 700 to 800 is very good. And to banks, this is like gold. I mean, like I said, anything over 700, and they're going to do the deal. It's not going to be a question of your credit score, maybe something else that keeps you from it. And then if you have an 800 to an 850, that is an excellent credit score. And I mean, myself, I don't know how people get that kind of credit score, but anyway, everything has to be perfect on that. So anyway, the normally 670 and above is good for a lender. Now I've seen people with bad credit with a pretty good score, and then I've seen people with good credit. When I really look at what's there, it's really bad. I mean, the score is bad, but the number is really low. And I'm thinking, how can this happen? And it happens because of the way that credit model is used. It depends on the points they give for certain things, like the points they give for 30 days late, the points they give for how long you've had your credit, the points they give for how much credit you're using out of your available credit. And those are kind of the big things right there. Now the worst, and you're not going to believe this, and when I got into lending, I couldn't believe it. The worst credit is having no credit. And I just couldn't believe that. It was like, well, how can you do that? You don't even know what his credit is. But that's the point. They don't know if it's good. They don't know if it's bad. They have no idea. So anyway, when you have no credit and you've never gotten credit and you don't come up with the credit bureaus, banks are not going to give you a loan. I mean, unless they know you well, unless they really value your company. Maybe you're just a cash company. You've dealt with cash all your life and you've never gotten a loan or never gotten anything. But I tell you, I've been through it before, and I've seen banks just turn down loans, great loans that I thought good loans, because the person didn't have any credit. And you just shake your head. How can you have no credit? But anyway, some people don't. But banks feel that no credit is the worst credit. If you have a bad score, or even a score that's kind of low, the one thing you really want to do is you want to go ahead and look at the actual trades. And the trades are the companies, and then to the right of those, usually they will have, they'll have the account number, and they'll have what the limit is, 3,000, 1,000, 500. And then to the right of that, they'll have little boxes usually, and that can be done several different ways. But they're for the months of the year, and sometimes several years. And they will show how, if you've paid on time. And if you haven't, then they'll show that you've been 30 days late. 30 days late, once or twice is not a big deal. But if you have like 60 days late, 90 days late, a couple 30 days late, your credit score is going to show it. I guarantee it. But if you do go through those credits and go line by line, you also want to look at if you've had any hiccups in there, any 30-day late or whatever. You want to see what it is. I mean, is this some health charge that you got? It's for $10 or for $100, and you said I ain't paying that because that was the insurance company was supposed to pick that up, or was it like a cable bill? You had a disagreement with the cable company, or was it a phone bill? You had a disagreement with your cell phone company. A lot of those type of things, the bank isn't going to worry about too much. So if you have bad credit and it's based on, some health problems you had where you had bills and you maybe didn't pay them too quickly because you were waiting for the insurance, or if it's a cell phone or a cable company that you had problems with, and you said, hey, I ain't going to pay this bill until you straighten out your problems. That's all in good. It's all in fine. So I'm sure the company was real scared when you said that. But I guarantee you it's going to hurt your credit. So what I tell people is, I don't know what the principle is. It doesn't really matter. If you're talking a couple $100, pay it, even though you're waiting for someone else to pay it. Just pay it. Just don't let it go to a collection agency. Collection agency is one of the worst things. Bankruptcy is probably the worst, and then you would have collections, and then you would have judgments. And judgments are, you don't pay somebody, they take you to court, the judge says you got to pay this bill, so that's a judgment against you. Those three things are probably the worst, other than just not paying. I mean, I've had people tell me before, I have great credit. Yeah, I run my credit, I got great credit. And then you run it, it's the worst credit you've ever seen in your life. They aren't even paying their bills. You got to have people calling you every day. So, when you tell a bank you got good credit, I always run your credit before. Run your credit to make sure exactly what that score is. You can even run it. The Credit Karma is not perfect. It's not you're not going to get a score to score type thing with like a TransUnion, but it'll be very close. So you can have a good idea off a lot of these free sites. And then of course the one free site where you get one credit bureau a year for free. The problem is they don't give you a score with it, so you got to pay for the score, which is really crappy. So anyway, you can sometimes approve a loan if you have improvement in your credit score. So if you've had even a bad thing, even a bankruptcy 2 years ago, and you've straightened up your credit and you've made every payment on time since, and everything looks good besides that one thing that's dragging it down in the dirt, a lot of banks will go ahead and go through SBA, and a lot of times SBA will let stuff like that slide as long as you've improved it and you are continuing to improve it, and it's been a while. It's been a year or two or three. The three things, this is the three most important items for getting a business loan. The number one was cash flow. Number two is credit. And the number three is collateral. And a lot of people don't think of this one too much. If you're going through a bank, like I tell people, you don't say you want an SBA loan. You say I want a bank loan. I want a loan for my business. And the bank is the one who will tell you if you need an SBA loan. Now, some banks just do SBAs. They do everything as an SBA. And the reason is because they go ahead and sell that off in the secondary market. But normally collateral is really kind of, the first way out on a bank loan for a banker is you pay your payments in a timely fashion until that loan is paid in full. The second way out to a banker is that you stop making payments, you default on the loan, and he sells your assets, which is your collateral, and also any additional collateral you gave him. He sells those to pay off that loan. And that loan will include interest and probably fees too. So it is always good to go ahead and not to end up with that second way out. Now, banks only want you to get their loan back, or they don't only want their loan money back, they also want interest and fees. And if you're not paying, those fees can add up and that interest can add up because you could go to a higher tier in the interest. You really have to read your note to really know, and most people don't read their note. I mean, it's all written in kind of legalese, so half the people don't even read it. But you should read it. You should key in on things like, what happens in a situation of default, what's your interest rate go to, what are the fees, and things like that. There is what is called, what I think everybody calls, well, I don't know. But anyway, there's the third way out for the bank. And that's when you sign your personal guarantee with the bank when you got the loan. You didn't think a thing of it. The bank said everybody has to sign a personal guarantee. And when you talk to other banks, they say we all get a personal guarantee unless you're InBev or unless you're Boeing. They probably don't have a personal guarantee for their president or their stockholders or anybody. But you will sign a personal guarantee. And what happens if that money in the collateral isn't enough to pay that off, then they're going to sue you in court. And they're going to sue you because you made a pledge, you guaranteed this loan. And to show your guarantee, you gave them a personal financial statement. So they're going to look at that personal financial statement and they're going to say, hey man, what do you got here that we can take? And they're going to look at your house. They're going to look at all sorts of stuff, anything of value on there. Now, this is a part where you could also get in trouble. I've seen people that to get the initial loan, they lie on their personal financial statement. They say they've got a whole lot of stuff they don't have. The bank doesn't check it out. When they go out of business and then the bank is looking for collateral, they don't have enough collateral to pay off the loan. The person's in default. So they go to that third way out. They sue them in court. And they're using that personal financial that they gave them. Well, if all this is bogus stuff, then you stand a good chance of maybe going to jail. And I've seen people go to jail for that very reason. So, you can bump up a little bit, whatever values. You're not an expert. You're not an appraiser. You're not, your cash is whatever's in the bank at the moment. But I tell you, if you blatantly lie, then things can turn bad for you. So anyway, that's the three most important items for getting a bank loan or any loan from any lender. The three most important, remember, are cash flow, to make sure you get enough money to pay off the debt, credit, it's a bank's best indicator of whether you're going to pay off the debt, and number three would be collateral, because that's what they're going to have to sell if you default on your loan and you don't have the cash to pay them back. That's what they're going to rely on. So anyway, thank you very much. I appreciate you staying until this long in the video. If you like content like this, please subscribe and hit the notifications bell for future videos. And if you liked anything on here, if you got value out of it, I hope you hit the like button. And thank you very much, and I'll see you in the next video.